This video is going to be devoted to understanding interest rates. Interest rates are certainly one of the most important considerations for almost any home buyer. And if you are going to shop for a home, you need to understand them. Why? Well, for most people, your home is likely to be the largest purchase of your lifetime. And unless you are at a point in your life where you have built up significant equity in a previously owned home, you are probably going to use a loan to meet your purchase price. Therefore, interest rates will likely impact your budget and therefore the type of home you are going to look for. Now, I'm not going to assume any knowledge of interest rates going in. So if you are a little more experienced with this material, hang in there. So what is an interest rate? Well, first of all, there is a difference between the interest rate and what's called an annual percentage rate, or APR. We'll talk about that in a future video. But simply put, an interest rate is the cost to borrow money. It's usually expressed as a percentage that will be charged against your loan amount, or loan principal, per year. So for example, if I lend you $100 and charge you a 6% interest rate and tell you to pay me back in a year, you will repay me a total of $106. Now you may notice that you get a small bit of interest on your savings account. That's because you are actually lending a portion of your savings to the bank, and they can turn around and use that for their own purposes. Interest rates are important to lenders because they first provide profit. Lenders want to make money, and that's why they are in the business of making loans. So without that potential profit, no loan. Second, interest must more than account for inflation that occurs over the life of the loan. As I think we are well aware of at this point, inflation is a general rise in prices across a period of time. As a result, our money doesn't buy as much after prices have inflated. So back to my example of the $100 loan. If I lent you $100, but I wanted to be a good friend, so I didn't charge you interest, instead I just asked that you pay me back the $100 in a year. Well, if inflation was, say, a 7% that year, my $100 I lent you would have less buying power when you paid me back. All of that stuff I could have bought with $100 last year when I lent the money would now cost me $107. But I still only have the $100 you paid me back. I effectively lost money. Now you, the borrower, you actually came out ahead. You paid me back with $100 that was essentially less valuable than when you borrowed it. That $100 worked harder for you when you borrowed it than it did when you paid it back. In this case, you, the borrower, actually made a profit of sorts. So interest rates on a loan are generally designed to create profit for lenders and protect against inflation. But depending on what inflation actually ends up being, those scenarios can play out very differently for borrowers and lenders. Now remember, interest rates apply to pretty much any loan, so these rates vary pretty widely depending on the type of loan. While they are generally connected to the overall economy, student loan interest rates are going to be much different than personal loan rates or automobile rates. For our purposes, we are of course going to turn attention to mortgage rates, or rates on home loans. Generally speaking, mortgage rates tend to be somewhat lower than other types of lending interest rates. That's because mortgages use the value of your home as collateral on the loan. If you don't pay your loan payments, the holder of the loan can possess the house and sell it to recoup some or all of the value of the loan. Of course, this is not a good thing for borrowers, but the value of your home's collateral presents less risk to the lender, thus the lower rates. Over the past 50 years, mortgage rates have regularly moved up and down, as you see here on this chart. Rates on 30-year mortgage loans have been as high as over 18% in 1981 to as low as under 2.7% in January of 2021, with an overall consistent downward trend in rates over those 40 years between. So the question is, why do interest rates change and who decides what they should be? Well, let's start with the second question first. Simply put, and really it's not quite this simple, the Federal Reserve Bank, or the Fed, uses several tools to change interest rates. If you didn't pay attention to high school economics and you don't know what the Fed is, that's the U.S. central banking system, a somewhat complex government organization or group of organizations that under the leadership of the Fed chairman and board of governors attempts to keep the nation's economy relatively stable. One of the economy's worst enemies is high inflation. The Fed's target rate for inflation is about 2%. 2% inflation generally means that people have money to spend, but that inflation isn't increasing at a higher rate than the general increase in our incomes. If inflation gets much higher or lower than 2% target, the Fed will react and make changes. This is where it can get complicated, and for the purposes of these videos, I'm going to stay out of these complexities as much as I can. But the Fed has several tools to try to keep inflation and the economy stable. Generally, if inflation gets too low, it means that people aren't spending much money. They aren't buying stuff. So this is a risk that the economy will stall and unemployment will increase. So to counter this problem, the Fed will try to increase the money supply. First, no, they don't print money to increase the money supply. That's actually the Federal Mint, not the Fed. And again, they have several tools they use. Most commonly, they might try to increase the money supply by lowering what's called the federal funds rate. This is the rate that commercial banks pay to give and obtain overnight loans to cover their lending and meet Federal Reserve requirements. Basically, the amount of money they need to keep the ledgers available to customers. Ever seen What a Wonderful Life when the bank doesn't have enough money to meet the customer withdrawal requests? Anyway, if the Fed makes lending cheaper for the banks, then the banks are expected to keep lending cheaper for the customer. If consumers can get cheaper, low-interest loans, they will borrow more money. If the consumer borrows more money, they spend it on big purchases like automobiles and homes. This, in turn, will fuel economic growth and increase the need for jobs. When people have more money to spend, prices will increase slightly, bringing inflation back to its target of 2% or so. Bada bing, bada boom. This is why mortgage rates decreased throughout the recession of 2008 and 2009 and the years following. Even after the end of the recession, spending was still somewhat slow and economic recovery was sluggish. So rates continued to remain low and were even dropped to those historic lows we saw in 2020 and 2021. Of course, the Fed reacts the opposite way when inflation gets too high. In these situations, usually the money supply is too high, people are spending too much, prices are increasing as a result, and thus inflation starts to increase. I'll make another video on current mortgage rates and our recent bouts with high inflation, but for the time being, when inflation is high, the Fed will try to decrease the money supply by increasing the federal funds rate, making it more expensive for commercial banks to get those overnight loans and thus forcing them to charge higher rates to consumers, consequently decreasing the rate at which consumers borrow and spend money on larger purchases. This slows the economy. It might increase the unemployment rate slightly, but prevents the economy from becoming a runaway train. If you paid attention in U.S. history class when you were a kid, you might remember the panics of 1819, 1837, 1857, 1873, 1893, and 1907. Panic is essentially an old word for an economic depression, and these were mostly all a result of out-of-control economic growth due to the lack of an organized monetary policy, leading to these crashes. Of course, the Great Depression of them all occurred throughout the 1930s and into the 1940s, but again, although the Fed did exist at that time, it exercised very poor monetary policy, something we hope to have learned from.